Most financial crises don't begin with headlines or emergency announcements. They begin quietly, inside regulatory filings, balance sheets, and footnotes that most people never read. That's why today's discussion matters. Because when a major financial institution changes how it manages liquidity, it often reflects pressures that haven't reached public awareness yet. Recently, Deutsche Bank disclosed a large reduction in what regulators classify as high-quality liquid assets. This wasn't a minor adjustment. It was a move large enough to raise eyebrows among professionals who watch institutional behavior closely. The goal today isn't to predict collapse or spread fear. The goal is to understand why a bank of this size would make such a decision, what it reveals about current financial conditions, and why similar moves across the system tend to happen long before stress becomes visible to the public. Understanding these signals early is how institutions manage risk, and how informed individuals avoid being surprised. Here's the first hook that matters: banks do not reduce their most liquid, regulator-approved assets without a reason. Deutsche Bank reported reducing its high-quality liquid assets by roughly $89 billion in a single quarter. That figure alone demands context. Banks rebalance constantly, but the scale and speed of this change suggests something more than routine portfolio housekeeping. High-quality liquid assets exist for one purpose: to ensure a bank can survive funding stress. When that buffer changes dramatically, it usually means the bank is adjusting to a different risk environment. This doesn't mean failure is imminent. It does mean management believes flexibility is becoming more important than holding assets that were previously considered safe and stable. In finance, when priorities change quietly at the top, the effects tend to ripple outward later. That's why this move deserves careful analysis rather than emotional reactions. To understand why this matters, you have to understand who Deutsche Bank is within the global system. This is not a local lender or a niche institution. Deutsche Bank is deeply embedded in international markets, with exposure to corporate lending, derivatives, institutional custody, and cross-border funding. Regulators classify it as systemically important because distress at this bank would not remain isolated. That classification also means the bank is monitored closely and required to maintain strong liquidity buffers. So when such a bank adjusts those buffers aggressively, it's reasonable to ask what pressures it is responding to. Large banks are not emotional actors. They respond to data, models, and stress scenarios. When those models start producing less comfortable outcomes, action follows. And action usually comes before explanation. Now let's talk about what high-quality liquid assets actually are, because the phrase sounds simpler than it is. In banking regulation, these assets include cash, central bank reserves, and high-grade government bonds that can be sold quickly without large price concessions. They are designed to protect the bank during short-term stress scenarios, such as funding freezes or market disruptions. These assets are not chosen for yield or profit. They are chosen for reliability. Think of them as the emergency oxygen tank of the financial system. Banks are required to hold them precisely so they don't need to panic sell riskier assets during stress. That's why a large reduction in this category raises questions. It suggests the bank is either reallocating liquidity elsewhere or believes holding different forms of liquidity is now more effective given current market conditions. The official explanations banks provide for moves like this are often technically accurate but practically vague. Terms like balance sheet optimization and adapting to market conditions appear frequently in disclosures. These phrases don't mean nothing, but they don't tell the full story either. In practice, they often signal that internal risk assessments have changed. Banks constantly run stress tests based on interest rates, funding costs, counterparty exposure, and economic conditions. When those tests worsen, management adjusts. That adjustment may involve holding more cash, shortening asset duration, or repositioning liquidity away from assets that have become more volatile. None of this requires a public crisis. It only requires management to believe that conditions ahead may be less stable than conditions behind. One major factor influencing these decisions is interest rates. When rates rise quickly, the value of existing bonds falls. This creates unrealized losses on balance sheets across the financial system. These losses can remain hidden as long as assets aren't sold. But liquidity needs can force realization. If a bank anticipates tighter funding conditions, it may choose to reduce exposure early, even at a cost, to avoid being forced to sell later under worse conditions. This is not panic, it's risk control. In environments where rates are higher for longer, long-duration assets become less attractive to institutions that prioritize stability. That shift alone can explain why banks become more defensive with assets once labeled safe. Here's a hook most people miss. Government bonds are not just investments, they are infrastructure. They sit at the center of short-term funding markets, especially repurchase agreements where banks lend to each other overnight using bonds as collateral. This collateral system allows trillions of dollars to move smoothly through the financial system every day. When banks reduce their active holdings of these bonds, or when bonds become more volatile, the collateral system becomes less efficient. Funding costs can rise. Liquidity can tighten. None of this causes an immediate breakdown, but it increases fragility. Think of it as reducing shock absorbers on a moving vehicle. Everything still works, until the road gets rough. When a large bank sells a significant volume of bonds, the effects aren't limited to its own balance sheet. Large sales influence market prices. And when prices fall, institutions holding similar assets experience valuation declines. This is called mark-to-market pressure. Even if those institutions don't sell, their internal risk metrics change. Capital ratios shift. Stress tests worsen. In response, some institutions decide to reduce exposure proactively. That's how selling can spread without panic. It's not emotion, it's math. And math-driven behavior tends to be synchronized across institutions using similar models. This is one reason why early moves by large players matter more than public statements. Confidence is another crucial element, and it operates very differently at the institutional level than it does for individuals. Large corporations, hedge funds, and treasury departments monitor counterparty risk constantly. When they see a major bank adjusting liquidity rapidly, they ask questions. They reassess exposure. They may reduce balances, demand more collateral, or shift activity elsewhere. These changes are quiet and procedural. Retail customers usually learn about stress last. This doesn't mean the bank is failing, it means trust becomes conditional. And conditional trust changes behavior. In banking, behavior changes often matter more than headlines. Zooming out, this move fits into a broader global pattern. For decades, the financial system operated under the assumption that government bonds were universally safe, not just from default, but from volatility. Recent years challenged that belief. Inflation surged. Interest rates rose. Long-duration bonds suffered historic losses. Assets once considered boring and stable turned out to be highly sensitive to macro conditions. This forced institutions to rethink what safe really means. Safety is no longer just about credit risk, it's about price stability, liquidity, and optionality. When definitions change, portfolios change with them. Around the world, financial institutions are adapting to this new environment. This doesn't require coordination or conspiracy. When inputs change, outputs converge. Higher rates, tighter liquidity, and uncertain growth naturally push banks toward more conservative positioning. Cash becomes more attractive. Duration becomes less attractive. Flexibility becomes more valuable than yield. These shifts happen quietly and incrementally. By the time they become visible to the public, they've usually been underway for months. That's why watching institutional behavior provides more insight than listening to reassuring narratives. It's important to separate interpretation from exaggeration. A large liquidity adjustment does not automatically mean collapse. Financial systems rarely fail overnight. Stress builds gradually. Signals accumulate. Institutions respond in phases. The right way to interpret this move is as a data point, one that fits within a larger pattern of defensive positioning. Dismissing it entirely would be careless. Treating it as proof of imminent disaster would also be careless. The rational approach is to understand why it happened and what conditions make such decisions more likely. For individual investors, the lesson is not to copy institutional trades blindly. Institutions operate under different constraints. The lesson is to think in principles. Understand how interest rates affect your assets. Recognize that diversification only works when assets behave differently under stress. Avoid unnecessary concentration in a single institution or asset class. Maintain liquidity so you are not forced to act during volatility. These are boring principles, but boring principles tend to survive unstable environments. Another key insight is that financial systems are adaptive, not static. They respond to incentives, regulations, and macro conditions. When those conditions shift, behavior shifts with them. What worked in a low-rate world doesn't always work in a higher-rate world. That doesn't mean the system is broken. It means the system is adjusting. And adjustments are rarely smooth. Understanding this helps remove emotion from analysis and replace it with context. One of the biggest mistakes people make is assuming that safety is permanent. In finance, safety is conditional. It depends on environment, structure, and behavior. Assets that were safe under one regime can become risky under another. Institutions that survive long-term are the ones that recognize these transitions early and adapt gradually. That's what liquidity management is really about: buying time, flexibility, and options. This is why actions matter more than words. Public statements aim to reassure. Balance sheet changes aim to protect. When the two diverge, professionals pay attention to the latter. Deutsche Bank's liquidity adjustment is not a headline event, it's a positioning event. And positioning events often tell you more about future conditions than press releases ever will. The broader takeaway is not fear, it's awareness. Financial stress doesn't announce itself. It reveals itself through small but meaningful changes in behavior. Watching those changes helps you understand where you are in the cycle. It doesn't give you certainty, but it gives you perspective. And perspective is what allows rational decision-making under uncertainty. Understanding these dynamics doesn't require predicting the future. It requires recognizing patterns. Higher rates lead to tighter liquidity. Tighter liquidity leads to defensive positioning. Defensive positioning leads to slower growth and higher sensitivity to shocks. None of this is dramatic. All of it is structural. And structural shifts tend to unfold over years, not weeks. So the final hook is this: markets don't move on what people say, they move on what institutions do. Deutsche Bank's decision to reduce high-quality liquid assets by a significant amount doesn't guarantee anything. But it does tell you that risk management priorities are changing. And when priorities change at the top, the rest of the system eventually follows. The goal isn't to panic. The goal is to understand the signals early enough to stay flexible. That's how informed participants navigate changing financial environments.